It's something we use every single day, but almost no one really understands where it comes from. I'm talking about money, of course, and the seemingly magical ability of banks to create it right out of thin air. Today, we're going to pull back the curtain on that magic trick. So let's start with a puzzle, one that seems to completely break the basic rules of math. A bank takes in $5 million in deposits. Then it lends out $4.5 million. So, how much money is now in the economy? Simple logic says $500,000, right? But the real answer is $9.5 million. How is that even possible? Well, solving this little riddle is the key to understanding our entire financial system. On the one hand, you've got the simple arithmetic they taught us in school. But on the other, you have this strange reality of modern banking. And look, this isn't just some theory. It is the fundamental mechanism that allows massive financial institutions to fund basically everything, from giant skyscrapers to tech startups. It's how our global economy is shaped. So how on earth is this possible? To get our heads around this strange math, we need to rewind. We have to ask a much more fundamental question. What even is money in the first place? Believe it or not, the story of money doesn't really start with economics. It starts with psychology. It all began with this huge mental shift, a move away from things that are directly useful to things that are purely symbolic. Early societies, they used forms of money that had real, tangible value for survival. We're talking about things like cattle, salt, or barley. But these things were a real pain. They were super hard to divide up, difficult to transport, and worst of all, they could spoil. A cow is useful, for sure, but you can't exactly pay for your coffee with a fraction of a cow's leg. And then came gold. Gold solved all of these problems. It's rare, but not so rare you can't find any. It doesn't rust or decay. You can chop it up into tiny little pieces, and it's easy to carry around. Plus, let's be honest, it's shiny, and we humans, we love shiny things. But, and this is the important part, for gold to work as money, it needed one revolutionary new ingredient. And that secret ingredient? It's us. It's collective belief. See, gold isn't valuable because it can feed you or build you a shelter. Nope. It's valuable simply because we all agree that it's valuable. We all believe we can trade it for the things that do feed us. It's just a shared story, a psychological agreement that turned a shiny, kind of useless metal into a global system of power. So, with this system of collective belief firmly in place, the stage was set for the very first great magic trick of finance, the invention of paper money. Think about it. People didn't want to lug around these heavy, risky bags of gold, so they started depositing their gold with a banker for safekeeping. In return, they'd get a paper receipt, basically an IOU, a contract promising to give back the gold whenever they wanted it. And pretty soon, these receipts were being used as money because they were just so much easier and safer to carry. And this is where the bankers had their aha moment. They quickly noticed that while people were out there happily trading these paper receipts, the $5 million in actual gold, well, it just sat in the vault, gathering dust. It never moved. So the original depositors are using their $5 million in receipts as money, feeling safe and sound. But the bankers, they're looking at all that idle gold, and they get an idea for how to make a little, or a lot, of extra profit. They realized, wait a minute, we don't have to lend out the physical gold. We can just issue new paper receipts as loans to other people, all backed by the very same gold that's already securing the original deposits. And boom, there it is, the solution to our initial puzzle. All of a sudden, you have the original $5 million in receipts, plus another $4.5 million in brand new loan receipts. That's $9.5 million circulating in the economy, all backed by only $5 million in actual gold. They had literally created new money, not from gold, but from a promise, from nothing. Now, this system was absolutely brilliant, right? But it was also, well, incredibly fragile. It faced two massive threats that eventually forced the entire system to evolve into the one we have today. First, there was the constant terror of a bank run. If everyone panicked and showed up at once, demanding their gold, the bank would instantly collapse because it only had a fraction of the gold it promised on paper. And second, their biggest customers were often kings who needed cash for wars. The problem? A king might lose the war. Or, just decide not to pay you back. What are you going to do, sue the king? So to manage these risks, individual banking families started forming these powerful cartels. This consolidation of power eventually led to government-backed central banks like the Federal Reserve. And then the final step came in 1971, when the US officially cut the tie to gold, turning our money into pure fiat currency, backed by absolutely nothing but our collective belief in the system itself.
Okay, so let's just recap. We went from cows to gold to paper backed by gold, and now to a system where money is literally just numbers on a screen, created by central institutions. This evolution forces us to ask a really, really challenging question about the very idea of scarcity.
Okay, think about it. If a central authority can create as much money as it needs, why does anyone have to be poor? Why does scarcity exist at all? Well, there's one challenging perspective out there that argues the standard answer, that resources are limited, completely misses the point of what money has become. This perspective argues that from our very first day in school, we've been conditioned to believe that money is a scarce, finite thing. But the system itself, as we've just seen, allows for its infinite creation. It's just numbers on a computer screen.
So, if poverty isn't a natural state caused by a lack of money, then according to this view, it has to be a manufactured one. It must be a tool that serves some kind of purpose. But what purpose could that possibly be?
Well, this perspective suggests that the system actually needs artificial misery to function. The very existence of poverty creates the illusion that money is scarce and therefore valuable. It's the fear of ending up poor that compels all of us to work hard, to get an education, and to participate in the whole economic system.
And if you follow this logic all the way to its conclusion, even huge destructive events like financial crashes and wars have to serve a purpose within the system, right? They can't just be random accidents.
This viewpoint argues that crises aren't bugs in the system, they're features. Their purpose is to periodically destroy wealth, wipe out savings, and reinforce that collective feeling that money is precious and hard to come by. In this view, it's a way to hit the reset button on the game and maintain the illusion of scarcity that keeps the whole thing running.
Which leaves us with a final, pretty mind-bending thought. Perhaps the entire incredibly complex financial system, from gold receipts to central banks, is just an elaborate illusion, a game created to organize and harness the one thing that has true, undeniable value: our time, our energy, and our labor. Is money just a tool to get us to work? That's definitely something to think about.